7 of the 10 worst cities in America to invest in residential real estate are in California. That is not a coincidence. It is a systemic breakdown. Behind the sunshine and celebrity culture, a perfect storm of exploding insurance premiums, mass outbound migration, and crippling inventory gluts is turning the Golden State into a financial minefield for buyers and investors alike. In this countdown, we are exposing the 7 riskiest housing markets in California for 2025 and 2026. We are going beyond the headlines to analyze the raw data. The staggering price-to-income gaps, the desperate seller price cuts, and the hidden risks that can turn your property investment into a financial nightmare. Subscribe to Housing Intel for the data-driven intelligence that protects your wealth. Let's begin. Number 7. Los Angeles. The City of Angels is becoming the city of overpriced regret. Heading into 2026, a median home price of $870,000 clashes violently with a median income of just $75,000. This affordability gap is not just a statistic, it is a structural crack in the foundation of the market. Monthly mortgage payments often exceed $4,200, and that is before you even factor in insurance premiums that have doubled due to wildfire risks. Property insurance costs in high-risk zones now routinely exceed $4,000 annually, a hidden expense that erodes returns for investors and crushes budgets for owner-occupiers alike. Los Angeles now ranks among the top cities for outbound migration, losing over 32,000 residents since 2023. The reason is clear: soaring living costs, rising crime rates that directly impact property values, and insurance premiums that show no signs of stabilizing. Even once hot neighborhoods like Echo Park and West Hollywood are seeing longer listing times and deeper price cuts, with over 23% of listings dropping their prices in the first quarter alone. For investors seeking appreciation or cash flow, the math is no longer working. It is still glamorous on the outside, but for those looking to build wealth through real estate, Los Angeles is increasingly becoming a liability. Number 6. Oakland. Once the Bay Area's bold, diverse, and affordable alternative, Oakland's housing market is now fundamentally unstable, heading into 2026. A median home price above $720,000 is crushing for residents earning a median of $80,000. But the numbers that will continue to dominate the market conversation are crime-related statistics. Oakland now ranks among the top 5 cities in the United States for property crime. Carjackings, break-ins, and violent assaults have driven many residents and investors to the exits. Over 12,000 people have left the city since 2023, and that exodus is accelerating with no signs of slowing down. Over 30% of home listings saw price reductions in early 2025, with homes sitting unsold for 60-plus days on average. Simultaneously, insurance premiums are climbing rapidly, especially in hillside neighborhoods prone to wildfires. Some homeowners are now paying 45% more than they did just 3 years ago. The result is a market bloated with inventory, but starved of buyers willing to take on the risk. Oakland's cultural vibrancy is real, but its housing stability is not. For investors, the risk-to-reward ratio has shifted dramatically and decisively against their favor. Number 5. San Diego. America's finest city is becoming one of its most precarious housing markets for the long haul. A median home price of over $850,000 against a median income of $82,000 means families and investors alike are being forced to spend over 40% of gross income on housing alone. And that is before taxes and insurance enter the equation. Speaking of insurance, rates here are skyrocketing at an alarming pace. Why? Because of growing wildfire risks, coastal erosion accelerating due to climate change, and rising sea levels threatening coastal properties. Premiums have jumped by more than 50% since 2020, and some major insurers are pulling out of the region altogether, creating a severe coverage crisis. Homeowners are left paying thousands for bare-bones coverage if they can secure coverage at all. Meanwhile, inventory is piling up dramatically, especially in overbuilt luxury condo markets and sprawl-heavy suburbs. Sellers are slashing prices just to stay afloat. In the first quarter of 2025, nearly 24% of listings saw price reductions, and it gets worse for long-term investors. Property taxes are among the state's highest, traffic congestion is worsening, and population growth has slowed to a crawl. Some areas are even seeing outbound migration as affordability collapses completely. San Diego still looks like paradise on the surface, but dig a little deeper. And for real estate investors, it has become a painful dream with a price tag few can justify. Number 4. Berkeley. Ranked by multiple independent analyses as the single worst city in the entire nation to invest in residential real estate, Berkeley is a full-blown affordability disaster. Despite its prestigious reputation as a cultural and academic hub home to UC Berkeley, steep home prices, extremely limited inventory, and below-average quality-of-life metrics create a perfect storm of buyer and investor frustration. The rent-to-price ratio is one of the absolute worst in the country, meaning both renting and buying are financially punishing for residents and investors alike. Cash flow is nearly impossible to achieve for rental property investors, and appreciation potential is severely capped by the city's already extreme valuations that leave little room for growth. In Berkeley, the dream of building wealth through real estate is, for the overwhelming majority, statistically impossible. For seasoned investors and newcomers alike, this market offers little upside potential and massive downside risk. Number 3. Santa Cruz. This bohemian surf town with its iconic boardwalk has a nightmarish price tag that will persist well into 2026. A median home price of $1.2 million compared to an average income of just $85,000 creates one of America's absolute worst price-to-income ratios. But the true long-term danger for investors is the trifecta of climate threats: flood-prone coastal zones vulnerable to storms, rising sea levels that threaten beachfront properties, and wildfire risks in the surrounding hills and forests. Insurance premiums have soared by 40% since 2022, with some properties now requiring special add-on fire coverage just to qualify for any policy at all. And in some extreme cases, properties are becoming completely uninsurable, making them virtually unsellable on the open market. But affordability and insurance are only part of this dark story. The market is cooling fast and showing clear signs of distress. Over 25% of listings saw price cuts in the first quarter of 2025, and average days on market have doubled compared to 2023. Investor interest has dried up completely, and younger families are fleeing the area, heading inland where housing costs are not financially suffocating. Number 2. Santa Barbara. A coastal jewel featuring stunning Spanish architecture, swaying palms, and seaside serenity. It looks like a Mediterranean fantasy come to life, but for investors in 2025 and 2026, that fantasy comes with a brutal and punishing price tag. Home prices here have ballooned to nearly $1.5 million, yet local median incomes average just around $90,000. That is not just a gap, it is a financial chasm. Listing times are up 60% year over year, and nearly 30% of properties dropped their asking price in the first quarter of 2025. Climate risk rattles this market. Wildfires in the nearby foothills, mudslides during winter storms, and drought conditions pushing utility bills higher. Insurance premiums have skyrocketed, with many homeowners now paying over $5,000 annually. Some hillside homes are being outright denied coverage by major carriers. At the same time, Santa Barbara is hemorrhaging its workforce. Between 2022 and 2024, over 8,000 residents left the area, straining the local economy. And the #1 worst city to buy or invest in California real estate is San Francisco. The capital of tech innovation has become the capital of real estate risk. A median home price of $1.35 million is just the start of this troubling story. Since 2021, a mass exodus of over 50,000 people, driven by tech layoffs and deteriorating quality of life, has gutted market demand. What is left behind? Vacant units, slashed rents, and growing inventory. In the first quarter of 2025, nearly 1 in 3 homes on the market had a price cut. Property crime remains rampant. Neighborhoods once booming now feel deserted. Public transit is underfunded. HOA fees exceed $1,800 monthly. Insurance premiums top $6,000 yearly. Even the luxury market is unraveling. Developers are canceling projects, and multi-million-dollar homes sit longer than ever before. The pattern is undeniable. These 7 California cities are flashing red alerts for 2025 and 2026. According to the California Association of Realtors, the market faces a sluggish period with only mild price growth expected. Sky-high prices, punishing insurance rates, and weakening demand are foundational shifts that will define the market for years. In this volatile environment, data-driven intelligence is your best defense. If this analysis opened your eyes, subscribe to Housing Intel for weekly market breakdowns. Comment below, which of these 7 California cities is the biggest housing trap? We will see you in the next breakdown.